Welcome to Spidell's California Minute. I'm your host, Catherine Zidane, and this week we're covering payroll tax increases that will be coming in January 2023 as a result of unemployment claims paid during the pandemic. We cover payroll taxes, including filing requirements, audits, and employee and independent contractor reporting rules in Spidell's analysis and explanation of California Tax's reference manual. You can pre-order the 2023 edition now at caltax.com under the Publications tab. Because of the unemployment claims paid during the pandemic, California is projected to owe over $19 billion to the federal government for its loan to the Unemployment Insurance Fund. As part of the California budget deal, California will pay $1 billion toward the loan over a 2-year period, $250 million this year with a non-binding agreement to pay an additional $750 million next year, which means California will continue to owe over $18 billion to the federal government. Unfortunately, when a state has an outstanding balance owed to the federal government for 2 consecutive years, employers have to pay additional payroll taxes. This means come January 2023, California employers will be paying an additional 0.3% on the first $7,000 of wages paid to their employees. As part of the budget deal, the governor and legislators agreed to provide $500 million in small business tax relief to help combat these higher payroll taxes that'll go into effect in 2023. However, all that was agreed to in the budget deal was the amount of relief available. Details as to who will qualify and what they'll receive haven't been worked out yet. The standard FUTA rate is 6%, but generally employers with a good claim rate history receive a 5.4% credit against the 6% rate, leaving the base minimum rate of 0.6%. But this credit is reduced in states that have an outstanding loan balance with the federal government, which effectively increases the FUTA rate. When a state borrows money from the federal government to pay unemployment benefits to its residents, it's the state's employers that make payments on the loan through a FUTA credit rate reduction. The FUTA credit is reduced when a state has an outstanding loan balance on January 1st for 2 consecutive years and the loan is not repaid by November 10th of the second year. The credit reduction is 0.3% for the first year and an additional 0.3% for each succeeding year until the loan is repaid. From the 3rd year onward, there may be additional reductions in the credit, although in the past, California has received waivers from these additional reductions. According to the California Legislative Analyst's Office, all things remaining the same, it'll take at least until 2030 until the fund is paid off. This means an additional $21 per employee in 2023, which could increase to as high as $189 per employee by 2030. The repayment period could be shorter if the state pays off more of the loan directly, or it could be longer if employment rates rise again. But we've been through this before. California borrowed funds from the federal government in 2009, and because California didn't repay its loan until May 2018, California employers paid more in federal FUTA taxes in 2011 through 2017. For 2017, employers paid an additional 2.1% in FUTA taxes per employee. The FUTA rate finally returned to 0.6% when employers paid their FUTA taxes for 2018 in January of 2019. Now, California once again is the leader in outstanding loan balances. As of September 2021, California's balance was over $19 billion. The next state was New York with less than $9 billion in debt. Only 10 states in total had outstanding balances. Stay up to date with news from all of the California tax agencies with a subscription to Spidell's California Tax Letter. You can download a sample issue and see what's included in this monthly newsletter at caltax.com under the Publications tab. That's all for this week. Join us next time for another episode of Spidell's California Minute.